I'm so excited to introduce our second guest speaker today, William Thorndike. Now, William's the author of what would be my third favorite book, which is right here. This is a very heavily annotated and notated book. I keep it right here in my desk drawer, close to my heart. And if you're a shareholder of ours and you haven't read that book, do yourself a favor. It'll be good for your life and good for your business and certainly good for your investing. Now, I have a formal introduction here I'd love to read, and we're obviously ecstatic that Will's with us today. Our second keynote speaker for today is Will Thorndike. He's a graduate of Harvard College and the Stanford Graduate School of Business. He's the managing partner of the Cromwell Harbour Partnership, a private investment company with a variety of long-term holdings. Prior to Cromwell Harbour, Will founded Housatonic Partners, a leading private equity firm with offices in Boston and San Francisco, known for exceptionally long investment holding periods. At Housatonic, Will was the pioneering institutional investor in the search fund asset class and played a central role in refining its acquisition criteria. Will is a founding principal at TTCER, a private investment partnership, a co-founder at Compounding Lab, an investment collaboration focused on long-term consolidations, and a lead investor at Banyan Software, a related platform in the vertical market software industry. He's chairman of the board at CNX Resources, a publicly traded New York Stock Exchange listed energy company, and the co-chairman of Everark Holdings, a London-based acquisition vehicle publicly traded on the London Stock Exchange. He's also director of several private companies, including QMC Telecom. Will is also a founder and jury member for the Singleton Prize for CEO Excellence, serves as a trustee for the Cromwell Harbour Foundation, WGBH College of the Atlantic, and the Land and Garden Preserve. He's a frequent lecturer at the Stanford Graduate School of Business and the Harvard Business School, and often speaks on both capital allocation and search funds. Will is the author of The Outsiders, 8 Unconventional CEOs and Their Radically Rational Blueprint for Success, which has been translated into 11 languages. He's the co-host of the 50X podcast. And just before Will starts, I think we should mention that Warren Buffett says, and I quote, "An outstanding book about CEOs who excelled at capital allocation." That's a pretty fantastic endorsement from somebody that we all admire. And so without further ado, welcome, Will.
Thanks very much, Brett. Very nice to be here, and very nice to be following Lawrence, who's terrific. So
now I'd love to start at the beginning because the beginning's a great place to start. You finish school, you go off to university. How did you sort of end up interested in investing? What was that journey?
It's interesting. My first job after college, after undergraduate, was working for an operating company in the publishing business. And the first summer after college, I went on vacation in Maine, actually where I am now, in the northeastern US. And as it often does in Maine, for the entire week of vacation, it rained. And so I'd brought 2 books with me, but by about Tuesday of the week, I'd finished both books, and I looked on the bookshelf of the house that we were renting, and I pulled down a book called The Money Masters, which is a book by a guy named John Train. It was published in 1980. I would still highly recommend it as sort of a foundational investing text. And it's basically a profile of roughly 10 outstanding investors. The first chapter is on Buffett. And I read that first chapter on a rainy day, and I had sort of a, stereotypical light bulb moment. And I sort of knew immediately that that's what I wanted to do. And I actually sent away, you had to do that by, snail mail in those days, for the collection of Berkshire letters. And I read them all and sort of disappeared down that rabbit hole, which I've been happily wandering around in for, 30 plus years now.
So after that moment, and I think many of us have had a similar experience. I know when I read Hagstrom's book, I think it was 1997, I wrote to Berkshire, they would send you these bound copies of Buffett's annual letters. Was that before you went to Stanford or after?
Before I went to Stanford. I actually went to Stanford partially because Stanford at that time had a legendary investing professor, a guy named Jack McDonald. who taught a second year class in investing. And really at that juncture, sort of the early 90s, he was really he was the lone outpost of sort of bottoms up value investing in traditional business schools, which, generally had people who believed in efficient market theory, kind of guarding the gates to the curriculum. And Jack McDonald taught two classes. He taught a class in the fall, and if you got a good grade in his class in the fall, you could apply to the spring seminar. And in the spring seminar, you showed up twice a week to hear from different amazing investors for 90 minutes. And Phil Fisher was still alive. He came and spoke, if you're familiar with him. Buffett came every year but my year, because the year I was there, he had his hands full running Salomon Brothers. But it was just an amazing, wonderful class. So one of the reasons I selected Stanford was that it had, very uniquely at the time, truly outstanding curriculum in this area through that one professor, Jack McDonald.
And so you leave Stanford. What were the sort of next steps? And full of this knowledge, how did you start to try and, execute some of what you'd learned in small ways as you built some capital?
Yeah, so basically right out of business school, I had a chance to work for two individual investors in the Boston area who were at the time in their mid-50s and looking to invest personal capital in private companies. And so I went to work for them literally out of a closet in the Back Bay of Boston, looking for private company investments for their personal capital. And from the outset, we brought in a group of outside co-investors who are also sophisticated, long-term oriented individual investors. And we made a series of investments on a deal-by-deal basis, 8 investments over the first 4 years. And those businesses had the economic characteristics that, we have always focused on, which are very much sort of core Buffett principles. They were businesses that had, very strong recurring revenues, very close relationships with customers, clear, identifiable competitive advantages, and they were in long-term growing markets. We still own 3 of those 8 companies today, kind of amazingly, 25 years plus in each case. Anyway, from very early days, we were focused on a very specific type of business. Yeah.
And so you're, as a young man working in these investment roles, was the structure of how you invested set up so that you could accumulate capital and grow some capital on your own account, or were you an employee or co-owner?
Yeah, the reason I chose to work with those two guys out of this closet was that, as opposed, I had other alternatives to go work for, larger firms, but I had a chance to earn a carried interest in their capital from day one. So I had extremely low current compensation, but I had a, meaningful equity opportunity if we generated interesting returns from day one. So that was key part of my thought process in joining them.
It's a good thing to explore, because in building out the Kelly Partners model, it's really been about making sure that young professionals have an opportunity to build a business and earn an equity return much earlier than they would in comparable, typical other situations where they would stay an employee for much longer, which we think has created alignment and a much better situation for our people. But I think a lot of young people don't know how to make that step and haven't done that reading, hence my sort of interest there. After you go on and you have the career that you've had, how do you come to write the book The Outsiders? And in particular, what, after a long investing career, made you think that was it another sort of light bulb moment that made you think let's write this book, or was it something that you found in research that you were doing, or how did that come about?
Yeah, it wasn't a light bulb moment. It was much more organic and incremental than that. So at the firm that I founded after joining those two guys was called Housatonic Partners. And every other year we would host a conference for CEOs, for the CEOs who were running our existing portfolio companies, for the alumni whose companies we had exited, and for CEOs who we were wooing to run future companies. So we did that every other year. And about 15 years ago, the format for those is we go somewhere to a resort in the Western US for 3 days. And we have a series of speakers come in, and we always have headliner speakers, people like Jim Collins and Michael Lewis and Nate Silver, and a bunch of people like that have come over time. And then we have more pragmatic, practically oriented talks. And about 15 years ago, I raised my hand and said, I'll do one of those more practical talks. And I then had to figure out what I was going to talk about. And I decided I would profile, an exceptional CEO. And I had done a little bit of reading about Henry Singleton, the former CEO of Teledyne, who's one of the chapters in the book. And we had a Harvard Business School student working for us between years at business school that summer. And I asked him if he wanted to do an independent study in his second year in business school to do a deep dive on Singleton for this talk. And this guy had played college tennis. He's a wonderful guy. And he turned to me and he said, Will, unfortunately, I've just committed to another independent study, but my doubles partner is looking. So I called up his doubles partner. It was a guy named Aleem Chowdhury, exceptionally talented guy. He'd been a Phi Beta Kappa in physics at Stanford, and Aleem agreed to do it. And he did a full year independent study, and we did a very deep dive on Singleton and Teledyne, his company, and all of the peer companies, all of the 60s era conglomerates. And in the first semester, we did a deep analytical dive, and in the second semester, we interviewed everyone alive who'd had anything to do with the company, former board members and investors and employees and competitors. And anyway, the whole, and it just ended up being incredibly, much more intellectually interesting than I'd expected. And so as I was writing up the research, preparing for the talk, Aleem came to me and he said, Will, there's a really talented guy in the class behind me who's looking for an independent study next year. Do you want to do another one of these things? And so that was a guy named John Gilligan, who was a summa in chemistry from Harvard, right? So I ended up doing one a year, really deep dives. The students and the HBS students got full year credit. And then they got me access to the Baker Library, which is the library at Harvard Business School, which is the world's leading repository of historical business information, which is essential for the data piece of this. So we did it, over time. I did one a year. Incredibly slow pace for such a short book. It took me a year per chapter. But after about the third or fourth one, it occurred to me this, might be something more. There might be a book project here, but that only dawned on me over time. So it was not a light bulb moment.
So was it 8? Did it take 8 years to do the 8 CEOs, or was it slightly?
8 years. It took 8 years.
Yeah. And as you're going through these projects, did the sort of thought currents start to come together, or was it 3 years in that you thought, well, hang on, there's some similarity here?
Yeah. So what I expected when I did it, the loose model I had in my mind as it was going along was that book I referenced earlier, The Money Masters, and which profiles, 8 to 10 great investors. So the point of The Money Masters is there are all sorts of different approaches to investing that can produce exceptional long-term returns. There's a variety of paths to exceptional results, which is what I expected as I was going through the work. But after about year 5, it just became clear there was a very strong pattern, a much stronger than anticipated pattern across the group. And that held very strongly across the 8.
And so when you then pulled the book together, did you pull it together as a book, or was it really a manual for use within Housatonic? Was it informing the way that you were investing within the business?
It really came together as a book. It wasn't really a playbook for Housatonic, although some of the learnings I think have been beneficial to us. I mean, the big difference when you're investing in private companies is that, as the control investor, which at Housatonic we usually are, not always, but we usually are, you really do have control over capital allocation, which is something we'll talk about, one of the key areas of overlap across the 8. Whereas in a public company setting, as an investor, you usually don't have control over that, right? So the CEO how the CEO thinks about capital allocation in a public company is critical. In a private company, we theoretically, or not theoretically, we are actively involved in that process, working with the CEO, partnering with the CEO. But if we have disagreements about that, we ultimately control. So it's a little bit different. But some of the lessons in the book have made their way into our playbook, including the power, even in private companies, of opportunistic share repurchases. That's something we've executed across a variety of our companies, private companies over time. But that was a major lever of value creation for all 8 of the CEOs in the book.
So, Will, for our listeners today, our shareholders, could you explain what you think, what are the major principles of the book, and how you think potentially our shareholders should think about our business with respect to those ideas, but also how they would use those ideas in their investing life generally?
Yeah, sure. So, at a high level, the book is a study of 8 high-performing CEOs who each had to meet 2 tests. So first, they had to have better performance over their tenure than Jack Welch had during his tenure at GE. Now, Jack Welch's star has dimmed pretty considerably in the last 3 years or so, but his returns while he was in the seat at GE were truly exceptional. And so there was sort of an absolute test, better returns relative to the broader market than Jack Welch had. And then the other test, which I think is actually the more important of the 2 tests, is they needed to meaningfully outperform their peer group across 2 market cycles, a minimum of 2 full market cycles. So all of the CEOs in the book met those 2 tests. And it turned out that there were, if you looked in detail at the key decisions that drove the value creation over their tenures, there was very high overlap in a couple of key areas. So the first of those areas was in this area of capital allocation, which we've touched on a little bit. And the way I would think about capital allocation is if you are CEO of a company, you basically have 3 ways that you can raise capital to invest. The first is you can tap your free cash flow. The second is you can raise debt. And the third is that you can issue equity. That's it. And then there are really only 5 things you can do with that capital, right? You can invest in your existing operations. You can buy another company. You can pay a dividend. You can repurchase your stock, or you can pay down debt. Again, that's really it. But over very long periods of time, and the average tenure for the CEOs in the book was 20 years. And Brett, you're very early on. You've got at least 20 years to go from here. But over very long periods of time, it turns out the decisions CEOs make across how to source capital and how to deploy it have a massive disproportionate effect on long-term outcomes, per share outcomes for their shareholders. So if you think about it very simply, if you had 2 businesses that had identical operating results, same level of revenue and the same level of profitability or cash flow, and 2 different approaches to capital allocation, fast forward 10 or 20 years, you'd have 2 very different share price outcomes for shareholders. And so these CEOs shared a very specific approach to capital allocation, and we can go into more detail on that, but it was very different than their peers' approach to capital allocation. So that was one area of commonality. The other area of commonality was they had a similar, and Lawrence got into this in his talk, really well, but they had a similar approach to sort of organizational design and culture. And basically, they had a strong preference for decentralized organizational structures and the related culture of sort of frugality and entrepreneurialism and pragmatism that goes with that. So those were 2 areas. And then, just as a personality-wise, they were interesting because they came from a wide variety of backgrounds. So one was a former astronaut. One was a widow who had been out of the workforce for 20 years. One was an investor who had never run a company before. 2 were very high-level mathematicians, right? So they variety of backgrounds, but they shared some common characteristics. All of them, all 8 were first-time CEOs. That's maybe the most surprising finding in the whole book. Half of them under 40 when they got the job. Only 2 of them had MBAs. 4 of them had engineering degrees. And if you were going to reach for adjectives to describe them, you would not reach for the typical CEO adjectives, sort of charismatic, visionary, and strategic. Instead, you'd use words like pragmatic, flexible, cool, rational, agnostic, patient, humble, words like that. So the profile was, really in some interesting ways quite different. So those were some of the findings, Brett. And I think if you look at, Kelly Partners, I think if you read your owner's manual, I think it's very clear that you have a similar focus as you're sort of thinking about running the business, and sort of a laser focus on per share outcomes. We can talk more about that, but in the long run, what matters for shareholders isn't whether the business in absolute terms grows a lot, it's whether it grows a lot per share, gross profitability per share. Ultimately, that's what the market will focus on.
It's a great point. And Will, it's not that well understood because, I often say that people are very focused on absolute size, and scale, obviously, as Buffett says, has some advantage, but how you get there is important as well in terms of how much resource you consume to get to that size. And so our focus has always very much been not doing another dollar of business unless it meets our metrics and doesn't absorb, more capital than it should. Early in my career, I worked in a software company, and they pioneered the first piece of software that sought to essentially industrialize Rappaport's EVA theory, so that you could plug it into Bloomberg, take the feed, and get a view of 30 different ways of looking at investment returns, but in particular EVA. So for our shareholders who don't know what economic value added is, it's getting a return, above the weighted average cost of capital. So that very much, at I think I was 23 at that point, influenced me strongly. I was around an ex-maths professor and an entrepreneur, and people that really understood finance. But they were very much about, you've got to get somewhere without consuming an enormous amount of resources. It also sort of taps into that sustainability, theory that's around these days in terms of why do less with more when you can do more with less. And then from a personal point of view, when I started, I didn't have a whole bunch of capital anyway. And so we had to find ways to invent capital through smarts and effort. So it's very much informed the culture of the business. When I look through your sort of 7 big principles, capital allocation is a CEO's most important job. What counts in the long run is the increase in per share value, not overall growth or size. Cash flow, not reported earnings, is what determines long-term value. Decentralized organizations release entrepreneurial energy and keep costs and rancor down. Independent thinking is essential to long-term success, and interactions with outside advisors can be distracting and time-consuming. Sometimes the best investment opportunity is your own stock. With acquisitions, patience is a virtue, as is occasional boldness. Now, I noticed in your introduction, and I've seen online, you're involved in the Singleton Prize for CEO Excellence. And so, every time I reread your book, and this is a very well-read book I have here, Henry Singleton seems to stand out very strongly as a person and as a CEO. Could you share with our shareholders, is Singleton the sort of prototypical ultimate CEO?
Singleton's he's just a fascinating character because he's sort of an extreme, right? So Singleton's background is he's a brilliant scientist and mathematician. So he goes to MIT here in the Boston area, and he gets a undergraduate degree, a master's, and a PhD in electrical engineering. In his PhD thesis, he programs the first computer ever at MIT. He then, it's around the World War II era, he does a bunch of pioneering work on radar, and he invents a technology called degaussing that allows Allied warships to avoid radar detection. He then goes in, after the war, he goes into the private sector, into R&D for Litton Industries, another electronic component, and he designs the inertial guidance system that is still in use in commercial and military aircraft, right? So when he's 23, before all that, he wins the Putnam Medal, which is given to the outstanding young mathematician in the United States. So he's a absolute top tier STEM, genius level guy. He's a grandmaster in chess. He likes to play chess blindfolded. Okay, so he drops down into the business world with that background as a CEO. He starts a company when he's about 40 years old. He has no experience running companies or anything, and he ends up building a conglomerate during the 1960s. And everywhere along the line, his whole wiring is just to sit down himself and do the math and figure out how to create the most value. And so over time, this leads him to involve an entirely differentiated approach to running his conglomerate versus everybody else in the United States. So he never splits his stock. He ends up repurchasing over time 90+% of his shares outstanding. He runs an unbelievably decentralized organization. It's actually the closest analog to Teledyne when it was run by Singleton is the company that Lawrence is on the board of, Constellation Software, where, I think there are, 500 operating units of Constellation. Singleton had 130 of them, but, only 20 people at corporate. And so he has a complete, and he does not spend any time providing guidance to Wall Street or any time with the business press. He just doesn't view that as a good use of time. So no one can really figure out what he's doing. But over long periods of time, he just has unbelievable otherworldly returns. So if you're one of his shareholders, you're extraordinarily happy. So for his first 25 years as CEO, he generates a 25% IRR. So if you had invested $10,000 with him, it would be worth 250 times that. So later. So just kind of incredible off the charts performance. But he's sort of an extreme because of the background. But those principles, those actions were taken to varying degrees by a number of the other CEOs in the book, and a number of other current CEOs, including Mark Leonard, the CEO of Constellation, following very similar approaches, very similar playbooks.
So on Constellation, and we've been very much inspired by what Mark's done at Constellation. But what has been so interesting over the last 12 months was that when we first connected with Lawrence, he was the first person ever from any investor, any investment banker, or anyone I've ever dealt with that understood the benefit of mastering the acquisition process and doing more acquisitions, but not necessarily increasing the size of those acquisitions. And so, everyone I'd previously met had said in order to grow our group, we would need to grow the size of the acquisitions that we make over time in order to move the needle. Whereas my view from the beginning was that you could simply make more of the same acquisitions and just get better and better at what you're doing. Now, I haven't spent a lot of time explaining that to the world because you tend to be in a conversation with yourself, and it's better to prosecute the argument by delivering in the business than prosecute the argument in a theoretical sense with anyone else. But I'd love to hear your thoughts on sort of Constellation. They've done 600 transactions, 25 countries, 25 years, 100 countries. And are there other examples of where large businesses have been able to be built without having to take on what are typically regarded as transformative acquisitions that in 95% of cases transform in the negative direction?
Yeah, that's a great question. And it is a distinguishing element of Constellation's approach. I mean, their average transaction size across those 600 transactions is $5 million. Average enterprise. It's kind of remarkable. Mark sort of built a machine to systematically buy smaller companies because they're less efficient. And there are analogs from the book that John Malone, who was a CEO in the book, who ran cable television companies.
John's my favorite in the book, by the way, Will.
He's amazing. Malone's amazing. I mean, and actually he and Singleton are really, they're the two high-level mathematicians. Lots of similarities between those two, but Malone was operating in the cable television business in the United States when it was truly a monopoly business. And he just built a similar formula for buying lots of little cable companies at very low multiples over time. And then he would improve operations. In that case, it wasn't just best practices. He was able to, buy their programming at a significant volume discount. So sort of overnight, he could lower their cost base, but he had a formula for that. And if you look around, there are other examples. I mean, among current companies, The company I think in many ways is most similar to Constellation in the US market is TransDigm, which is run by a wonderful guy named Nick Howley, and they buy niche aviation components. So these are essential pieces of hardware that go into aircraft frames. And they can never, you can, once one has been approved by the FAA, it's in there forever, but it's on a regular replacement and service cycle. So it's a wonderful business that's wonderful economic characteristics. Unit economics are very good. It's a highly fragmented market. And Nick Howley, who's got an almost identical tenure to Mark Leonard, has been running that company in that same industry, focused like a laser beam on that industry, built mostly through small acquisitions over almost 30 years now.
So for us, do you see that there's that laser focus, long runway, and not getting distracted? There do seem to be some strong examples for us to follow.
Absolutely, Brett. I think you're very much on that same path, and why divert from that, right? I mean, you've got a highly fragmented market. You've no shortage of accretive deals you can do. You've figured out a best practices sort of playbook that's, I think, exceptional. And you're sort of developing, like a big piece of this is how do you get the finance flywheel going so you don't need any more equity capital? That's the key to and in Mark's case, it's been a free cash flow machine. And in TransDigm's case, Nick Howley's been a little more comfortable using some debt. He's created a lot of value that way, actually. But they both evolved their own approach to flywheel. But you're well down that path.
So it's great that you've used that term, because just for our shareholders, I shared that I got an email on a Saturday morning. I was literally in the butcher's picking up some meat for a barbecue, and I looked at my phone when it dinged, and there was an email from Lawrence there. I had a similar situation where I just absolutely love Will's book, and then I got this email. I think it was on a Friday, and I looked at my phone and I went, oh. And I thought it was somebody talking about Will's book, but it was Will himself. And then in subsequent conversations, the two incredible insights that we've had over the last 12 months from Lawrence, it was, 600 transactions, average deal size at Constellation, 5 million. Hey, Brett, you're right. You don't have to do bigger and bigger deals. And that has given me a great sense of peace that we can just keep doing what we're doing, and that there's at least one person out there that sort of understands what we're on about. And then in chatting with Will, what was terrific is since the inception of Kelly Partners, every person that's joined, we've given a copy of a book called Good to Great by Jim Collins. And the reason is, Will, that I always believe that a lot of people talk about culture as if it's an input, whereas books are an input that give people a common language, and an output from a common language is a culture. You can't be Italian really if you don't speak Italian, because you're really not going to understand the nuance of the culture. But what was fascinating about that book from my point of view was it just resonated: disciplined thinking, disciplined people, disciplined action. And that resulted in this idea that Collins pioneered called a flywheel. And so that's a long explanation for our shareholders in that when I first got on a Zoom with Ken and Will said straight out, he said, hey, Brett, I think you guys really have a flywheel on the move here. And as we have been building the company, I so often use that term that you would have to push this thing up hard. And over time, though, you'd start to get this flywheel. And if you just stuck at it and just kept pushing, eventually you got some momentum, and momentum's just incredibly powerful. So, Will, you made a huge contribution to our group, because from the other side of the world, when somebody with some clues can actually see what we've been trying to build. And for our shareholders, I'd love them to understand that our businesses pay a 6.5% central services fee and a 2.5% IP fee that we deploy 100% of that. That's 9% of revenues in making these businesses better. Accounting firms generally, they're partnerships. So in a partnership, all of the money that's made each year is typically just paid out to a partner. There's no retained profits. There's no investment in any flywheel. And so those businesses, while they can uniquely remain profitable in the accounting industry, they don't necessarily year to year become stronger and stronger businesses. And so I guess can you share with our shareholders that sort of conversation that we had in terms of we've definitely got a financing flywheel and an acquisition flywheel around how to do deals. I believe that reinvestment from our businesses is giving us an ability to continually play at a level that our peer set are just not going to be able to touch. What do you think the long-term impact of that type of focus can be?
I think it's extremely powerful, Brad. I mean, I think, you guys, you just have a very long runway in front of you to keep doing what you've proven you can do very accretively. And so that's very exciting, so I mean, I'm a shareholder, so I can't make any, stronger statement of confidence than that. And I don't say that lightly. But I think you guys have, the ability to create an enormous amount of per share value over a very long period of time by continuing to do what you're doing very well today. The number one thing I think, or no, a thing to focus on will be how do you finance that, and how do you, in the most accretive possible way. And I love the idea that you're comfortable staying focused on smaller transactions. That overlaps very closely with my experience creating value in private companies with similar approaches over decades. And inevitably in these long scale projects, if you look back at where the value is created, it's the smaller transactions over time that end up adding disproportionate value. And the temptation to do a really big one and move quickly is, that's a primrose path.
Yeah, it's great to hear you say it. It's definitely something we've reflected on. I always think of See's Candy in that sense. It was a small transaction that's delivered enormous value over time. I'd love you to share, if I can, while we have you, the impact that Jim Collins has had on you. I know that you knew Jim as a very young man. I think you met him early on in your career. He's been very influential in the way that we think. As you were talking then, I've been very influenced by his long march idea. What are your thoughts on Jim's work and how he's influenced you and your background with him?
So I had the benefit of having Jim as a professor when he was in business school. He was a lecturer at the Stanford Business School when I went there in the early 90s. So it was before he left and began to write and sort of built his second career. He was very young. He was in his early 30s, but he was consistently ranked as one of the 2 or 3 best professors at the business school. He was probably 33 years old. And I was able to take his class, which, by the way, I had to audit because there was a lottery system and I couldn't get into it. So I had to audit it. And then I've read everything he's ever put out. He was the first headliner speaker at our first CEO conference, where he presented the Good to Great research a month before the book came out, which was unbelievable. And, there are a group of us who've, known him over time, and we keep in contact with him. He's an advisor to one of those companies I mentioned before that we're still invested in from our, very earliest days. And he's an incredibly powerful thinker. He's sort of got he refers to it as monk mode. He sort of fiercely protects his time and ability to, focus deeply on projects. And he's been a very important influence for us and for our companies over a long period of time.
I really appreciate your time, Will, and I could speak with you for ages, but while we have you, we promised that we would open the floor for questions. And for anyone that would like to ask Will a question, please pop it in the chat, and we'd love to give you the opportunity to ask some questions.
Right, we've got some questions in the Q&A section. So this is from David, who said, "The Outsiders book is one of my favorites. All of the companies discussed in the Outsiders book are no longer listed other than Berkshire Hathaway. What US and international companies listed today exhibit outsider characteristics? Thank you."
Yep. Let's see. So the ones that come immediately to mind, we've talked about 2 of them already. So Constellation Software, Mark Leonard is very definitely following that path. Nick Howley at TransDigm is very definitely following that path. Mitch and Steve Rails at Danaher have been following that path for a very long time, and they've entered a very interesting new phase there over the last 5 years, but they've been building that company for 37 years. There's a home builder in the United States called NVR that follows these principles very closely. A lot of these companies, by the way, sort of by definition, these CEOs often don't like to spend time, as I said, talking to Wall Street and the business press, so the companies tend themselves to be quite low profile. But NVR would be another one. There's a company called Credit Acceptance Corp that has an unbelievable long-term record, follows these principles very closely. There's a company called Archery Insurance that's done a remarkable job over a long period of time in the reinsurance industry. And there are a few others, but that's a handful to sort of get started.
Terrific. There's another question there I can see. Mr. Thorndike, if it's not a personal question, how many copies did your book sell? Alan, that's a good cheeky question from
cutting right to it. Yeah, it sold. I mean, I'm not sure it's sold, reasonably well, and it continues to. It sells steadily, is what I would say, and it's a couple 100,000 copies.
Yeah. Well, that's it's very, very interesting. Is there a scope for a second edition of The Outsiders, Edward Vesely?
Yeah, I don't. So I'm not going to do another version of the book. I think the ideas are in that book. I'm not going to do another, the second edition with 8 new CEOs. And I do think that I might do an expanded edition of the book and add, say, 2 chapters. I think there's an interesting nonprofit example of this that I'm interested in writing about. And I'd like to do a company outside of North America. So I may add 2 chapters and do an expanded edition, but I don't plan a full 2.0.
There's a great question from Anoop Kalra. Given the dislocation caused by technology today and the fact that franchises are less durable than in the past, are there any characteristics of a CEO that you believe are especially needed today?
Yeah, that's a good question. I think that the sort of core principle, the sort of this idea that these CEOs are sort of deeply rational and continually evaluating the data. That's sort of their lens. I think that's a very powerful sort of mindset. It becomes even more valuable the more dynamic the environment is how I would describe that, right? So, an example from the book that's kind of interesting is if you looked at the Graham family. So there's one woman CEO in the book, Catherine Graham, who's amazing. Not just she's an amazing CEO, she has an amazing personal story. Her son succeeded her as the CEO of the Washington Post company, so a major newspaper in the United States and a broader media company. Extraordinary results relative to any other media companies, any other newspaper companies. The Washington Post company sold the paper. Her son sold the paper to Jeff Bezos 6 or 7 years ago. It would have been inconceivable 2 years before that to have thought that. So it's an example of sort of the pure rationality. Basically her son, Donald Graham, determined that the monopoly, the newspaper business in the United States had a secular change, and they were just not going to be able to run it profitably, period. And once that decision was made, they took the next rational step, which was to actually sell it. So I do think having that a mindset that is just data oriented, consistently seeking information and then analyzing it and making rational decisions, that's the most powerful possible template. And the world is getting, the rate of change is increasing. So it's you can't sit back on top of a franchise and just milk it for a long time. That's that model no longer really applies.
It's very interesting, Catherine Graham, that you mentioned, Will. Warren Buffett bought into Washington Post company, assured her that he wouldn't, that he was a white knight, not a predator, if you like. He seems to have spent a huge amount of time working with her. How influential do you think Warren was with respect to Catherine Graham's performance and ability to get through that time? And also, the enduring, I guess, contribution that he's made to that family, the son, etc.?
I mean, I think it's impossible to overstate Buffett's influence on Katharine Graham. And Katharine Graham gets enormous credit for that. So when Buffett made that investment in the mid 70s, Buffett was not a household name the way he is today. In fact, no one really knew who he was. And she met with him and immediately determined that this was somebody who she ought to be listening to. And that was against the advice of all of her board members, who were her husband's, sort of trusted coterie of advisors, big, fancy, lawyers from fancy New York and Washington, D.C. law firms and this and that. She basically told them that, sort of overruled them, put Buffett on her board. And then more than that, sort of designated him as her key advisor, her true mentor, and then ended up, with under his tutelage, making some really, really unconventional decisions that over time created enormous value. So she gets a lot of credit for that. Very hard to do that. You can look back on it today and say, oh, of course, she saw Buffett and brought him on board. Yeah, that was very unconventional at the time.
Yeah, absolutely. We've got a couple of great questions here. Could you name the non-profit that you mentioned that you'd like to study for a chapter of?
I can't name it quite yet, but it's a foundation in the United States that has an entirely different approach to everything about the way it runs its operation, including how it invests its endowment. And I think there are lessons there that are powerful and deserve a broader audience. So more to follow on that one.
Terrific. Who was Will's favorite CEO in the book and why?
That's a completely unfair question.
Choosing between your children.
Choosing between my children, exactly. Yeah, I think it's a horse. I mean, first of all, I learned an enormous amount from this project. It was just really fun, and I could go in detail into each of the CEOs and why that was particularly fun. And to crisply answer that question after my rambling around here, it's probably a horse race between Singleton and Malone.
Yeah. I've got to ask you, Buffett attributes Tom Murphy as the best CEO he's ever seen. Did you ever get to meet, I believe he's still alive, have you ever met Mr. Murphy, and what was your impression of him?
Yeah, Murphy is, yes, I have, is the short answer. I met with him during the book project. He was very generous with his time during working on the chapter, but I've also seen him a couple of times since. He's just a remarkable man, and an incredible mix of talents. And the interesting thing about him is, if you looked at Tom Murphy ran a company called Capital Cities in the United States, which had ran television stations and radio stations and other media properties, but really broadcasting businesses. And they just ran them way better than anybody else. And then they had an incredible record, acquiring and improving operations, not unlike Kelly or Constellation. But the other thing that was amazing about him is, if you looked at what happened in the United States, you have this idea of a coaching tree, which is you sort of look at where a great football coach, American football coach, where his inevitably it's a male in that sport. So where his assistants end up going, how did they do? How did his sort of mentees do? And the Capital Cities coaching tree is just unbelievable. And the best known sort of alumnus from Capital Cities was Bob Iger at Disney, who had an incredible run. He just wrote a book that's actually, I would recommend that book. But Murphy remained a key advisor to him all the way through his tenure at Disney. And anytime he had a large deal, he would call Tom Murphy and get advice on how to process it. So that relationship remained very close. And Murphy was an example of someone who was incredibly personable, but also very, very rational and disciplined. And
it's very interesting, Will, in that Iger's been noted for making some very unconventional at the time, unconventional looking and large bet acquisitions, things like Star Wars and the Marvel comic franchise. But I never knew that he had Murphy as a mentor in the background, and Murphy, is certainly regarded by Buffett as the greatest CEO in history, in his view. But similarly, Murphy made the ABC acquisition, which was, again, a very unconventional transaction, at least with foresight at the time. In hindsight, looked pretty good, so pretty incredible, which is really interesting. I've got the last couple of questions here. What was the most appealing aspect of choosing to invest in KPG? I know that we got some questions from Will's mate Christian, who shot him off to Ken, and I would say that the quality of those questions indicated thoughtfulness, which is which we haven't always seen, which is tremendous. And we always love answering really great questions because it forces us to really think about our business. How did that process happen?
Yeah, I mean, Christian and I are working together in something called Unconventional Partners, and basically, we're looking for companies that we think, we can be invested in for 20 years. That's our lens, and that can have the potential to grow shareholder value at interesting rates over a multi-decade time horizon. So I'm investing personal capital, so it's that's sort of the purest form of alignment, and I'm really just looking for situations where there's an opportunity to grow per share value at interesting rates over very long periods of time with people who are trustworthy and fun to work with. And I'm looking forward to coming to a barbecue at some point.
Yeah, in Australia.
That second box, but yeah.
Terrific. On behalf of all our shareholders who've attended today, I really want to thank you, Will, for making the time. It's a huge commitment from Maine to tune in and share your wisdom. I consider the association we've had with you to have been hugely rewarding and a huge amount of fun. My particular joy in life is learning and getting around people that are cluey is just the most type of fun. So thank you so much for tuning in and sharing with us today.
Thanks for having me, Brett. Take care. Thank you.
Awesome. Thank you.
Bye.